Well, hello there, everybody. Welcome in to our webinar event for the Q4 update of the markets. I hope you guys are having a great day, great morning, wherever you are in the world. Thank you for attending this webinar event. It's been a while since I've held one of these, and I am actually pretty excited to be back. It's a pretty interesting feeling, to be gone for a while and you come back. And I really appreciate you guys tuning in from all over the world to attend this event. This is probably one of the biggest webinar events we're going to be holding, and we have a special surprise for you at the end. Make sure that you stay on till the end. I swear it will be worth it. We're going to make it worth your while. Okay, so this is going to be a educational slash informational webinar. And I want to make sure that we start off really nicely here. So I'm going to kind of introduce myself a little bit. For those of you that don't know EGA, don't know what we're about, who I am, what do I do, and why are we holding this event. My name is Tushall Sharma. I am the CEO and founder of the Everyday Growth Advisors. And I have been investing in the stock market for about 9, coming to 10 years now, right? I've been trading options for about 4.5, coming to 5 years now. And I have been through one financial crash in my entire trading lifetime. Yeah, so it has been an interesting journey, that's for sure. I have seen ups and downs in the markets, and I have been through multiple booms and throws. So I'm holding this event to bridge the gap between institutional investors and retail traders. That is our aim at EGA. Our aim has always been to help the little man understand what the big fish are doing. Okay, I just recently graduated with my master's with honors from St. Mary's College in California in finance, Masters of Science. And I am currently a CFA Level 1 candidate, which is the Chartered Financial Analyst program. For those of you that don't know, it is a prestigious program that allows you to get a accreditation. I currently manage a single portfolio that is about 7 figures, and also 2 other smaller portfolios, which are 6 figures, which are dividend portfolios and a long-term index fund portfolio. Okay. The 7-figure portfolio is up 36% year to date. However, it is currently suffering a drawdown because of Chinese equities, which is one of the things we will be discussing today. Okay. And also, for the past 5 years, I have managed to achieve a above the benchmark return on all of my portfolios, and I'm going to teach you exactly how to do so in this webinar, and if you follow along with our journey going through with EGA, right? Using my personal style of value momentum investing, which is a very new generational way of thinking about investing, right? You don't just concentrate on the value of something, you also concentrate on the momentum of something and the secular trends that they come with, okay? So let's jump into this webinar. I hope you guys are ready. Let's unpack everything that we have in store for you, and let's get it on. So I'm going to very briefly go through the agenda for today. This webinar is going to be roughly about an hour, and I hope that you enjoy it as much as I do. I'm going to try and make it as interesting as possible. We're going to be covering inflation first. For those of you that don't know how it's measured, I'm going to briefly explain to you what inflation is. What are you supposed to watch out for in the coming months, in the coming 6 to 8 months, which are the peak inflationary months that we are going to be looking at. Of course, inflation-proof stocks. How do you find them? What do they look like, right? And then, of course, we're going to look at the Chinese market update of the unfolding story within China, as well as the US market update for Q4 and beyond. I'll also give you kind of my insights on what I think about the US market performance for the next year. And also at the end, we have a special announcement and then Q&As. So right now, all of you that are here, all 45 of you, thank you for attending. Welcome in. I just want to make sure that you guys can hear me fine. If you can hear me, give me a quick thumbs up. Also drop a heart if you can. And what's up? Hi guys, welcome back. Yes, the sound is great. Okay, man, I've missed these. Welcome back, Cody. Appreciate you being back here. Thank you for your kind comments. Yes, it has been a while since I've done these webinars, and I'm truly enjoying being back. So hey, maybe I will be sticking around after this. Okay, if you have questions, post them in the comments. I will review the questions as they come in chronologically. So the faster you post the questions, the chances are yours will be answered first, later when we get down to Q&As. And I'm going to go ahead and start the webinar right now so that we don't waste any more time, and let's get this down without a frown and peel some onions. For those of you that know what I'm talking about in the classic EGA fashion, let us peel these onions. Okay, so let's talk about inflation here. We have had a lot. This is a main topic, right? This is something that is really ongoing. The news headlines have been going goo goo gaga over it, right? We've been talking about inflation and how we have actually got into this moment, right? Well, mainly this has been a accumulation of the COVID crisis, and along that COVID crisis, which happened last year, what actually happened is we had supply and demand shock. So for those of you that don't know, during the COVID crisis, the propensity to consume greatly decreased, right? A lot of you would have realized that you would have actually cut back your spending last year. And this is a natural law of supply and demand. When crises happen, individuals are less likely to consume. But then also, there were certain pockets of the market that were over-demanded. Think about Clorox, think about toilet paper, think about all of the essentials that people were stocking up on for absolutely no reason. These caused major supply and demand shocks in various pockets of the market. Okay, so we're just not even talking about goods now, we're also talking about services. We're talking about jobs, okay? And jobs is the life force of the economy, right? So a lot of people actually got furloughed, a lot of people got out of their jobs, and that created a huge shock, right? So imagine if you have studied economics before, the entire supply and demand curve moved to the left, right? And all of these things would have caused all of the levels of pricing to go haywire, right? Now, right after this happened, as the market, or as we started to come out of COVID last year, we tried to come out of it. Do you remember at some point of time, there was a point where governments were like, okay, you know what, we're just going to open back up. And during this time, we had pent-up demand that seeped out into the market. So a lot of people who were holding back spending started spending again, but they started spending so aggressively that it caused supply shocks. So then the supply that wasn't there, that was not being anticipated for, got all sapped up. And this caused prices to go higher than usual, right? Now, obviously, this was a combination of different things. And now there are talks about hyperinflation, and there are talks about how the Fed's money printer, which has been going brrr for the long time, is also going to add to the mess, right? And I keep talking about this in our Discord channel and our mentorship courses, during the beginner course and the technical analysis course, where we discuss about technical formations of the market, where we discuss the actual structure of the market and how bond markets relate to everything, that these trends are not sustainable for the long run, right? So let's talk about a little bit about understanding inflation, right? First of all, you need to know the beast before you can tackle the beast, right? So how is CPI or inflation measured? Well, the Fed Bureau of Labor and Statistics, they measure CPI by looking at a basket of thousands of objects. Let's talk about the Big Mac, right? It's considered one of the objects in the CPI basket, right? Maybe blueberries or corn. How much do these things cost per certain value? And they look at the price adjustments of these and the sensitivity of these prices over time. And this is all put into an index, and that index starts to rise, right? Right now, that index is at 6.2, which is the highest it has been since the 2008 financial crisis. And this is the reason why alarms are blaring everywhere. Oh no, we're going to go into inflation. We're going to go into hyperinflation. And the reason why is so, we're going to get to in a little bit, right? I'm going to talk about it, and I'm going to tell you why this may be a problem or not be a problem, right? And also, you have to realize that inflation is not only a metric that is measured by the cost of things. It's also measured by the cost of wages. Remember that majority of our economy is made out of goods and services. It's not just made out of goods, right? So even your job is a added, construct of inflation. So productivity, which is the output per man hour, right? As it increases, right? And increases in productivity, these things, they offset the wages that are gained, okay? So think about that for a second. When you work, you output a certain amount of man hours, right? And this increase in productivity, what it does is the more productive you are, the less you do. So the less you get paid, okay? And these wage gains, they typically turn into either inflation or profit margin problems for businesses. Okay, now what this translates to later on can be a problematic problem for businesses that do not have a sustainable economic moat. Okay, and we're going to talk about these businesses. There were a lot of businesses that you would have realized were around before the COVID crisis, and now they have disappeared, right? So the ones that were stable and they had good capex spending, which are capital expenditures, and they controlled their balance sheets during this crisis, they survived, right? So what do we watch for here, right? This is important, right? What do we look for here? Well, we have to look at the stabilization of supply and demand in global supply chains. We have to also look at the stabilization of gas pump prices. You can know that this is a big problem right now, right? We're talking about gas prices in California are almost at $6 or $7 per gallon, which is crazy, right? And then also, all of those overstocking that consumers have done during the COVID crisis, they need to start to flush out all of that stock, right? Maybe you have a batch of TP that you bought from last year. Some of you, tell me if it's true, maybe you have stocks and supplies from last year when there was a run, right? And we need to continue to watch the CPI number and see how this performs in the next coming months, okay? So now let's talk about the purported problems of inflation, right? These are the perceived problems. This is what people think are the problems, right? And what is that? When we talk about that, we talk about M1, which is money supply. Okay, money supply. Now, money supply is the amount of money that is printed by the Fed. Okay, money supply. Now, you can see that through the 1960s all the way to 2020, the amount of money printed has been increasing. But look at what happens right after the 2020 crisis, right? We've had an insane amount of money being printed, right? Now, is this a problem, and how does this get addressed, right? In fact, you need to understand something, that 20 to 30% of all dollars that are circulating right now were printed in the last 12 months, okay? And all of this money that is circulating, it is perceived. It is perceived. Remember, I'm not saying that it is, but it is perceived. It is assumed that it's going to cause an increased competition for goods and services, right? Which means your dollar and my dollar will be competing to buy the same products, which means that those products will now cost more money, okay? So these are some things that you need to understand about what the perceived problems of inflation are. Are they really problems though? Well, let's take a look, right? Because when we talk about inflation, we have certain misconceptions, okay? And these misconceptions are that money supply is the one that causes inflation, when actually it is not money supply that causes it. It is the velocity of money supply, which is what we call M2, or the velocity of M2, okay? M1 is typically all the cash that is printed. M2 is all of the money plus the stock plus all assets that are translated between financial institutions and the such, right? But remember, it is not all the money that is in the system that is circulating, right? So you need to understand this. The money might be in the system, but it's not in the hands of you and me. And that means that it can't affect inflation that badly, all right? So get that out of your head for a second, all right? Now, the velocity of money, if you realize, has been actually falling in the same period, right? Look at the big drop right here, right? Huge drop off in 2020, right? And this measures the actual circulation of money to buy goods and services. That's the velocity, the flow of money, right? So where is this money? Where is all of this money? Well, all of this money is making its way through the system, through the credit system, and are sitting in banks, financial institutions, and lenders. That is the reason why financials have been on a complete tear this year. One of the best performing sectors of this year is financials, if you don't realize, right? Why? Real estate too, right? Because these are two very, very capital intensive sectors that are benefited by banks in times of high inflation. They lend you the money at a higher rate so that they can stimulate the economy, and this is mandated by the Federal Reserve, okay? So remember, what may seem to be a problem might not actually be a problem. You need to always remember, what are the misconceptions? What are the perceived notions of the market? What are the fear-mongering tactics that the news and institutions use to price you out of this mess? Okay? And understand that, is inflation really a problem here? So let's look at a couple of things here. Okay? So let's look at where we are, where we have been. All right? So this is a report that was put out by Bank of America Global Research a couple of days back, almost 2 days back, and I'm sharing it with you guys. This is institutional grade research, right? These are things that you pay top dollar for, so that you can get a good idea of where things stand, right? These are the kinds of things that I share on our Discord community with the the commentary, so that you understand not to fear these things. Okay. These are also things that I share during the mentorship courses, which we hold, and which, by the way, enrollment is live for, right? So when we talk about inflation right now, we talk about CPI, right? We talk about how it has a big resistance at 6.3, okay? So have a look at how CPI moves. It is the red line through this graph, and over below it is the S&P 500 price action overlaid onto the same graph, right? We can see that CPI has risen to 6.2 multiple times in the past, and passed it only a few handful times, right? This 6.2 level, 6.3 level is a huge resistance actually for the CPI number, right? And the last time that we came close to it was in the 2008 crisis, which was at 5.6. This was where we were, okay? Prior to that was the 90s to 94s, and now we're starting to climb up to that number again, during the COVID shock, which was the shock for supply and demand, okay? So CPI rose to 6.2 in October 2021, and this has passed the historical level of 2008, but isn't a problem unless suppliers can't pass the cost along to consumers, right? Now, listen to this concept for a second, because this is extremely important, right? And right now, if you do understand this concept so far, I want you to go ahead and smash the like button on this stream. I really, really do appreciate it if you can do that for a second. I keep telling you guys, smash that like button in the past, and I really would appreciate if you, could just hit the like button, because this will actually allow more people to enter the stream and get this great knowledge that we are sharing with people, right? So when CPI rises, you need to understand that companies that have a very tough time passing the cost over to consumers, those are the ones that get affected, right? Their profit margins get squashed. But if you have a business, for example, like Ferrari, right? Think about a business like Ferrari. They have a very niche market. They have a very niche following. They have a very niche customer base. Do you really think a 5% price increase in Ferrari cars would make a big impact to their consumers? No. Why? Because they have very rich consumers, right? So it all depends on the monopolistic ability of these businesses to sustain a price increase and pass that price increase to the consumer, all right? And in turn, what this does is, if they are not able to, then this decreases demand, and in turn decreases supply of goods, and then creates a stagnant economy, right? All right. But we have CPI at 6.2, which is a pretty big resistance here. And this will be where we need to really look at it and see we actually do pass this number. It's kind of like the resistance point on where we look at these figures, okay? So we're going to talk further about, whether we can pass these things on to consumers. But let's also look at the probabilistic nature and the statistics of CPI itself, right? Let's talk about the data and the probability analysis of higher CPI numbers. What does it mean? When the times when CPI has gone past 6.3, let's also talk about those scenarios, right? So if CPI has not gone past 6.3, guess what? A higher CPI number does not equal to a stock market correction, okay? Actually, it has led to an average performance of the S&P 500 at 28.51% return, okay? So this is straight up, like, I'm talking raw data and statistics here, okay? The average performance of the S&P 500 was 28.51% when the CPI rose that much, all all right? And the CAGR, which is the cumulative average growth rate, was 10%, okay, during the same period. Now, what happens if CPI rises above 6.3? Now we kind of rise, we get into some problems. But the correlation is not the causation here, okay? The correlation is not the causation. So many investors, they start to freak out the moment they see these things on the news. But remember that the Fed is going to start tapering next year, and it's likely that when interest rates start to go up, that is going to cause, you know, majority of these effects to be neglected. Now, I'm also going to talk about other things. So let's go step by step here, right? So let's talk about, first of all, when CPI rises above 6.3, then what does the data and statistics look like? Now, I want to point out something. Like, we always look at data and statistics because this is the way that we do things at EGA. And this is also something we highlight in our mentorship courses, in the beginner's course, you know, and the technical analysis course. We don't take trade ideas, or we don't look at the market from an emotional standpoint. Because the moment you start to play with your emotions, that's when you start to make mistakes, right? You gotta always look at it from a non-objective point of view. Always remember that it is the probability and statistics that will drive majority of the price action, and not your emotions, okay? So what is the likelihood of something happening? That is what we concentrate on, and that is also the hallmark of what we teach at our beginner course and the technical analysis course, all right? So if you look at the most recent rise in CPI, it was from 0.1 to 6.2 in October 2021, and this led to the SPX rising 51%, okay? This is since the COVID crisis, all right? And this is mainly because many investors were expecting businesses to pass the expenses to consumers. That is exactly what happened, right? And expanding top and bottom line growth on these balance sheets. And this is something that has happened. If you realize the EPS and the earnings per share, or the expected earnings per share of majority of these big monopolistic companies, have only grown over the past 1 year. They've not shrunk in any way, right? Which you would expect to be a counterproductive thing or a counterintuitive thing. But actually no. Because these are great companies with solid economic moats. A company like Amazon, a company like Apple, Microsoft, right? They have solid economic moats, right? So these companies can pass the cost on to consumers very, very easily. Now, if CPI rises above 6.3, now we start to see that the average market performance starts to dip below in negative numbers, right? And that happened only 1, 2, 3, 4, 5 times in the history of the stock market, okay? And when this happened, the CPI peaks were at 13, 19, 9, 12, and 14, all right? And this led to the S&P 500 underperforming 3 out of the 5 times. In 2 of those years, the change in the S&P 500 during the same period was 22% and 44% up. And 3 out of those times were minus 38, minus 36, and minus 5%. So you can see here that this fear is slightly overblown. Okay, and that is the point that I'm trying to make to you. That is the point that I'm trying to get at. Now, if you still don't understand this concept, let's also go and understand something else. Majority of market leaders right now, what are they? They are tech companies, right? They are tech companies. The NASDAQ has been on fire for the past 2 years, and that is something that you need to understand, right? Majority of market leaders now are turning out to be disruptors that have taken control of technology, and they're harnessing it. And the COVID crisis has supercharged our economy to become more digital, right? Everything is more tech-based now. And technology is deflationary. It is deflationary in nature. Why? Because technology reduces the buying power for goods and services. How does it do so? Because technology creates automation, which eliminates jobs, and it reduces labor demand, which lowers wages. And one man's income is another man's wage, and another man's wage is another man's income. So this reduces the buying power of consumers, and it reduces the propensity to consume. which leads to lower prices for goods and services. Okay? This deflationary effect that we are seeing now is going to continue, and it will reduce the effects of the short-term inflation that we are finding. And that is the reason why Mr. Jerome Powell, our Lord and Savior, always talks about how inflation is transitory. Okay? Because of the pent-up demand that we have, this is going to cause a transitory level of inflation, but not a sustained level of hyperinflation like everybody is expecting. Because technology reduces that benefit. Okay? It reduces that effect. So, the bottom line, is inflation good or bad? Well, it kind of depends on what you own, right? Inflation is great for people who have assets. If you have real estate, or you have stocks and bonds, well, not bonds right now, but stocks, right? Real estate, and you have asset classes that tend to outperform, then inflation works for you because these productive asset classes, they tend to outperform in this environment. But what is inflation bad for? Inflation is bad for people who rely on wages and hold cash through the same period. That's the reason why you hear Ray Dalio and a lot of other pundits say cash is trash. Because look at the value or the purchasing power of the US dollar from 1900s to now, right? We've gone right all the way down here, and we are not stopping there. Obviously, it's kind of asymptotic at this point, right? It's not gonna become terribly worse, but still, okay, you need to understand these things. This is the reason why holding cash is trash, is because the value of inflation erodes the value of your buying power per year. And in an environment where you have inflation rising, that's going to cause you to lose even more of that value of your purchasing power. Okay, this is the reason why it is so important to educate yourself on what are the more investable parts of the market. That's what we do through our beginners course and the technical analysis course, which we're holding a sale for, right? It's through this education that you understand how to maneuver through the markets and what these great companies are, all right? So let's have a look at how do you find stocks that benefit yourself from inflation, right? So first of all, stocks themselves are inflation proof in the long run. And don't get this wrong, right? Stocks are definitely inflation proof in the long run. Why? Because even if you were a dummy, right, and you put your money in the S&P 500 over a 10-year period, right? Guess what? You would come out way ahead of many people who are actively trading, right? And you would still win against inflation or gold and silver, which are the supposed inflation plays, right? The playbook for inflation, because the S&P 500 has about a 10% adjusted return considering inflation over a 25-year annualized period, right? So putting your money in the S&P 500, closing your eyes and just dumping your money in there without even looking at it would have, increased your asset performance, and you would have had return on your investments over a longer period of time, all right? But if you are so interested in picking stocks to benefit yourself from inflation, how do you do that? Well, you have to look at companies that have strong pricing power. What does that mean? They can increase the price of their goods and services without losing a market share. Okay, these are typically monopolies, right? What are some of them, right? Think about it. For example, Johnson & Johnson as a business, right? You wouldn't even know, but you use some of their products, right? A company like, for example, P&G, Procter & Gamble, right? You probably use their products in the bathroom, your shampoo, your something, right? And all of these businesses, they have a monopolistic way because they could increase their price of the product by 5%. And guess what? You'll still buy it. You still need shampoo. How else am I going to get my hair like that, right, guys? Come on. And also, you need to look at these businesses that have good capex, right? Little to no capex. What does that mean? Capital expenditures, right? Not only that, they have to have a strong competitive advantage in their market segments, right? Which means they're leaders. They emerge out of the crowd when incumbents come in, or when competition tries to take market share. They stand strong and they don't let them, right? Then you also look at secular trends and leaders, right? These are all your key points for stocks that combat inflation. Because you have secular trends that are going to win out in the short run. These are more short-term focused, right? What are some short-term secular trends? AI, green tech, right? Machine learning, cloud tech, cybersecurity, right? These are all of the stocks that were running extremely hot. And now in this next year, we'll have financials which are already priced in at the point, right? And lastly, you have REITs. What are REITs? Real estate investment trusts. What is a REIT? A REIT is like buying a conglomerate that has real estate, right? If you don't have a lot of money to invest into properties, what you can do is buy a slice of a property, which is a REIT. It's kind of like it's kind of like ETF investing, but for properties, right? So you can buy REITs, and one such REIT is RWR, the Dow Jones Total REIT ETF, right? Go look at the performance of the RWR this year. It is up and it is almost at all-time highs. Why? Because the housing market has been on absolute fire this year. Why? Because houses tends to increase in prices when inflation does. So some notable names of these kinds of businesses are Johnson & Johnson, Amazon, Adobe, Meta, right? Facebook, right? Salesforce, Nike, Ferrari, like I was mentioning earlier, right? These are very, very inflation-proof stocks. There are much more that you can think of, but these are the ones that stand out from the crowd, right? They also. So remember that there are ways to get around the market when you are in a pickle. You need to remember to stay objective. Don't let your emotions take control. And even when the market's selling off in a uptrend, it does not always mean that we're going to go back down so quickly. Okay. How are you guys doing? Is everybody tuning in okay? Is the sound all right? Is you guys following it on okay to the webinar? Let me know. Also, remember to leave a thumbs up, a like in the stream if you're just joining us. Thank you for coming in. We appreciate all of the attendees, 64 of you. We truly appreciate you being here. Let's move on into this webinar. So, by the way, I want to also talk about another secular trend, right? AI and the segment leaders in there, right? Think about all of these stocks and their performance this year, right? Facebook, Amazon, Nvidia, which has undergone a split and now back at all-time highs. Alibaba, which is suffering, which we will talk about in a little bit. Apple, which has had a recent rally. Baidu, which continues to find a little bit of, struggle in the Chinese markets, but we're also going to talk about Chinese markets in a little bit, right? Google, which is now at all-time highs, right? And Microsoft also at all-time highs. Every one of these stocks in this segments have outperformed the S&P 500 by at least single digits or double digits this year, right? So remember, it's all about focusing on the leaders and throwing out all the bull crap, right? Now, recently there was also a secular trend which was popping up, and that was small caps, right? And we'll talk about small caps later, but have that at the back of your mind as we go through this webinar, all right? All right, so I want to start jumping into China here. We're done discussing about inflation. I hope that was, somewhat insightful for you guys. Why inflation's not thoroughly a problem, right? And why you'll see that inflation's gonna over time not be sustainable. It's because the way technology stocks are gonna be really affecting us and the way that we see technology growing, we're just on the precipice of a very turbocharged growth in all of technology and innovation right now. Where we are. Think about Tesla as a business 5 years ago and where we are. Think about EVs. Think about everything that's being developed right now. The digitization and the turbocharge of digitization, excuse me, through the COVID crisis, right? And the force that has been going through, okay? So now let's look at China, all right? Now, China is a very interesting one because China is definitely something that we didn't foresee being or performing the way that it did this year, all right? I will be the first to admit that I didn't expect the government to clamp down so aggressively, but we're going to look at everything and I'm going to try and rationalize this big move. We're going to try and digest this bitter pill that we had to swallow. Just so you guys know, my Chinese portfolio is down 30% this year. Okay? Now, many of you would be freaking out. Many of you, because I have been talking about China for almost a year. And we have been talking about this growth secular trend and this market, which has been so niche and has so much of room to run for a long time. Now, has my thesis changed? Has my argument changed? Has my expectations changed? I'm going to cover all of these things in this webinar, okay? We need to understand what the updates are, so I'm going to go through what has happened. And I also want to talk about the China versus US divergence. Okay? These are two things that we're going to talk about. So, just a quick update on Chinese economy, right? What happened in the beginning of this year and has been a classic theme that has been happening is that the Chinese government had begun to vigorously enforce antitrust laws with the idea of helping consumers and workers while promoting economic equality. Okay, China's economy slowed down, and their official GDP contracted by about 5%, which was actually quite a worrying thing because the reason why this happened was multiple bouts of COVID outbreaks, like 19 of them, okay, in regions, but they have been very good at controlling them. In fact, the Chinese government has been so nefarious with this, they have just ordered nationwide lockdowns to combat that, okay? And several large real estate firms, and we are talking about the Evergrande crisis, right, encountered financial difficulty lending, and then there was a sharp rise in high-yield corporate bonds, right, rising from 9 to 20% from July to September and then October, okay? This was something that was purported as a problem. The news over-sensationalized it. The U.S. stock market, of course, didn't really react that much, right? And then on top of that, throw another double whammy. We had the prices for coal and natural gas, which doubled this year, straining electrical grids, occasional power outages in certain provinces. And it hit Chinese firms harder than American firms because of the energy costs that were higher than America, right? So a lot of these things caused the economy to enter a gridlock, which has not really quite righted itself, okay? And for all of these reasons, people started to look at the Chinese market as not an investable space, and the market started to tank, all right? Global supply lines remain under stress, and shipping costs are from China to the US are still 4 times the pre-pandemic levels because of multiple levels of checks and balances. Now you can see that due to this, the S&P 500 and the Chinese markets have been in a complete divergence here. Okay? This cannot be lasting forever. right? It can't last forever. Remember that whatever goes up forever can't go up forever. Whatever that goes down cannot go down forever, right? So at some point of time, this divergence has to converge, all right? This is something you have to understand, right? And it's just a matter of time. So you have to be patient, right? Now, a lot of people got burnt in the Chinese markets this year because they were heavily invested in derivatives. And I very early on in this year mentioned multiple times that do not put all your eggs in one basket and make sure that you diversify across asset classes, right? Don't go too heavy on derivatives because they have a time value construct. You have theta and you have a bunch of other Greeks that act against your contracts. And when there is no interest in these markets, those contracts get completely destroyed. Now, I'm not saying that I didn't have any derivatives. I did, but they made up a very small percentage of my portfolio. Majority of my holdings still remain in shares of KWeb, Asher, and GXC, which are how I diversify my portfolio. And we'll talk about that in a second, okay? So before we jump into this, and how do we talk about the investability of the Chinese markets, let's understand a few key facts about the Chinese government, okay? This is super important. Now, you need to understand that the CCP, the Communist Party of China, they're an authoritarian government system, okay? And they hybridize a free market system, but consolidate power over the private sector. Now, when given a choice over individual versus national interest, they're always going to choose national interest because they have a modified socialism construct within their economy. And this might not make sense to you, but it actually is true. For those of you that have actually lived in China, you would realize that this is true. They operate on a very free market basis where they allow companies to come in and compete. And this is not necessarily a bad thing. It is an extremely good thing because they're trying to create a society where things are fair in terms of culture. They're trying to avoid an economy like the US, where a company like Amazon can accumulate a huge market share and then prevent competition from occurring by lobbying and by paying off individuals or institutions to do their bidding for them. And obviously, if you don't know that they do this, then you should probably read up on a lot of those things, right? In fact, Amazon and a bunch of other big tech companies are definitely going through these anti-corrupt practices, right? And they get fined very often doing this. Now, regulatory risks exist, obviously, when you're investing for the long run, and this includes the antitrust crackdowns, which are the monopolistic practices, and then data collection. Remember, we had, and cybersecurity, we had a scare with Didi. Didi basically was a company like, think about the Uber of China, and what they did was they listed on the Chinese government and said, screw you guys, we're just going to do what we want. And then the Chinese government said, oh no, you don't, and then slapped them, and they just basically nulled their whole IPO. And then remember what happened at Tesla when they first opened the Shanghai factory. There was a whole scare about them not allowing their cars to collect information on the roads, and that all of that information would belong to the Chinese government. So the Chinese government is very protective of these concepts. Okay, they want data collection and cybersecurity to be the forefront to protect their own national interest. And then, of course, this is not something about the Chinese government, but this is more of like a key fact that you need to understand about a certain risk. It's the delisting of Chinese stocks on US markets, which are driven by bills and lobbying within the US. Okay? This was mainly driven by initiative during the Trump era, and we're starting to see this a little cool off now. Do you remember that this was headlines maybe 6 months ago, right? So understanding these things are definitely an important part of it, right? So understanding the government, they don't operate by the same playbook as the US government does. They operate in a completely different regulatory tactic. They're very protective of their individual national interests. And understanding that concept is important to understand the Chinese markets, okay? Now let's talk about avoiding this risk. So majority of the risks that surround investing into Chinese equities can be definitely eliminated by performing your own valuations and understanding what businesses you're owning. Because the reality of the situation is not all of these companies are investable. All right, not all the businesses in the Chinese economy are investable. A handful of them are, okay, and you need to know that the handful that are have a very, very defined economic moat. Okay, Baidu, Tencent, your Alibaba, right? These three businesses, for example, are considered like the holy grail, right? And one such way you can learn this concept is, or learn this skill is, to look at our valuation techniques that we teach you in the beginner's course. We go through a intense 6-step process where we look at the company's investability, the economic moat, the corporate governance structure, right? Look at the balance sheet, income statement, statement of cash flows, to look at exactly how these businesses are doing, right? And Alibaba could be at $130 today, and tomorrow it could be at maybe $70. And you need to understand that the markets can stay irrational longer than these companies can stay solvent, right? So rationality is not always going to align with the market, all right? So before you think about these things, remember you have to do your own legwork. And if you don't know how to do this, then you have to buy them all, right? Buy them all through ETFs. And these are 2 ETFs that will allow you to forego that stock picking process, okay? So instead of trying to pick which one's going to be successful, purchase an ETF which has a basket of all of them. And this will offer you that diversification that you need for adjusted returns, okay, over a long time, right? So one of them is KWEB. This is your equivalent of QQQ. And then Asher is the kind of equivalent of the Dow Jones Industrial Average. And I'm going to show you what they both are, right? Obviously, I'm not paid to promote any of this. I'm just sharing with you what are the 2 instruments that I use. But there is something that you need to take note of, which is a risk here. And that is the risk of investing in ADRs versus Hong Kong stocks, okay? Now, not many of you know this, but the Chinese government actually prevents outside investors from investing directly into Chinese stocks. So these Chinese companies, they got smart and they started setting up shell companies in the Cayman Islands, which represent pieces of shares in the actual Chinese company in the Hong Kong Stock Exchange. These are what we call ADRs, or American Depository Receipts. What ADRs are simply a contract of understanding that when you own one share of this specific ADR, it is equivalent to this many shares of the Hong Kong stock equivalent. Okay. Now, actually, this was something that was clamped down on during Trump era, and then there was the whole talk about delisting and blah blah blah, right? But obviously, this didn't happen, and I still don't think that there is a very high chance of it happening, but it is a risk, and you need to understand that. Okay, it is a risk. All right. So if you're thinking of investing in KWEB, remember the majority of these are ADRs. All right, and Asher isn't. Okay, so we're gonna look at these 2 ETFs real quick. So KWEB versus Asher. I want to pull down the main important things, right? So look at Asher's asset allocation versus KWEB. These are majority common shares and ordinary shares, and that makes up 99%. And you can see in KWEB, you have 36% shares, and then you have 63% in ADRs, okay? This is important to note. The breakdown in terms of caps, large caps make up majority of both of these ETFs, mid caps make up a very small percentage, and then small and micro caps are, a very small fragment, right? When we look at sector breakdowns for Asher and KWEB, right? Asher is a more diversified construct and represents more of the Dow Jones Industrial Average. Financials make up the biggest weight, then come up IT or technology, right? Consumer non-durables, industry, like process industries, manufacturing, which these are kind of like industrials, health, consumer durables, technology, services, non-energy minerals, transportation. As you can see, it goes down in allocation, right? And then KWEB is mainly like technology stocks, right? And then retail trade, consumer services, transportation. This is, but majority of this is like QQQ, the equivalent, and this is like DIA, or the Dow Jones Industrial Average, right? The comparison is like that, okay? So investing in a mix of both of these will give you a diversified return on the Chinese market. And for me personally, I have a diversified portfolio that has both of these ETFs, okay? And then holding shares of this is what you want to really do. You don't really want to go balls deep into investing into derivatives, because you don't know when this market will recover. It could be 1 year, it could be 2 years, 3 years, 5 years. You don't know. But what is important to know is that it will eventually rebound, and then there is a ton of money to be made. Because when there is crisis, there is opportunity, right? And this is a market that has a deep crisis. Asset prices are so devalued. Stocks like Baba, which have a $300 intrinsic valuation on the high side, are trading at a 50% discount. This is where real wealth is made. Okay? Buy these things, hold them for a couple of years, and then become rich, right? That's the name of the game. That is investing. So overall, the Chinese markets, in my opinion, will see a rebound next year. That divergence that is occurring now has to converge. And even if we don't see it happen right away, I can guarantee you that right now we are in an accumulation phase, right? For those of you that don't know, we teach the different phases of the market in our mentorship courses. And doing that, you realize, the 4 phases of the market, right? Okay, great. So let's do a quick technical update with the US markets here. You guys enjoying the webinar so far? Everything okay? Remember, for those of you that are attending right now, thank you for coming in. Appreciate you guys being here. Much love to all of you. Make sure you smash the like button as usual. Definitely love being back. And all right, let's get the US market update. So, quick little update here for Q4 and a little bit about beyond. We'll go through technicals as well in a little bit. There are 29 days left in 2021. SPX is up about 25%. This holiday season should see traders take off due to no holidays taken in over a year, COVID crisis. It could be a silent closeout to the year, or it could be a bang. Of course, we, constantly will not be able to really tell. But just saying, people haven't taken a holiday in a while, and that's something that's important to note, right? There have been 14 instances so far since 1928 where the S&P 500 has been up more than 25%. And this is one of them this year, okay? Last year was 23%, okay? And this year, U.S. corporations have authorized $1 trillion worth of stock buybacks, which is the largest year on record. These are some key facts that you need to know. And here's a crazy one, which I still can't wrap my head around. Options notional volume have been insane this year. We had a single day hitting on November 19th, $842 billion worth of derivatives traded in one day through single stock options. If this doesn't blow your mind, I don't know what does. Okay, almost $1 trillion in options traded in one day. That is nuts. Okay, so the reason for me putting this on the slide is just to reiterate that options trading is becoming very, very popular. And a lot of people enter the stock market, they start options trading, and they get burnt. And I mentioned this on our beginners course and our technical analysis course. Students who have taken the course and you're in the comments right now and you are hearing my voice, tell me what happens to the people who join and start off with no peel the onion sessions and don't take EJ courses. What do they say? What is the acronym that we go? What is the hashtag? Who knows it? Come on, put the hashtag up. I'll write it down, but what is it? Right? WDGHM. For those of you that remember it, only OGs will know. Only OGs of this channel will know. Okay, so let's look at a couple of charts here. I want to go first through the S&P 500 total return by year, and then talk about the VIX index. Okay. So the S&P 500, as I said, returned more than 25% this year, and this is the third consecutive year with double digits, right? Now, it has been 5 straight years with returns above 20%, and this is starting to get outside our distribution of returns, all right? So once again, probabilistic nature of returns. This is what we concentrate on, right? We don't want to concentrate on, I feel that the market's going to do this. We want to look at the statistics. That is important, okay? Forget about everything else. It's noise. Remember, it is all about the statistics. What is the likelihood of something happening, right? So, where we are in terms of business cycle, economic cycle, monetary policy cycle, and then the bond market, right? Of course, we have valuations that are being supported so far, right? We do think, of course, that markets have a slight upside more, but we definitely don't think that next year is going to be another 25% year, okay? I think that next year we will go more towards the norm, which is closer towards 10 to 15%. Okay? We are likely to see more fluctuations than anything next year than we did this year. The reason is just purely statistical, all right? I'm not going by what we can predict because we can't predict jack shit. You cannot predict what is going to happen in the stock market, but what you can say is what is the probability of something happening. And since we've had a really big bunch of years with average highs, we're going to also see a big bunch of years with sustained flat returns, all right? And that is going to come in maybe the next couple of years, right? So next year you might see maybe reduced growth, and then maybe reduced growth, and then flat for a while. Okay. Now the other thing is the VIX index, right? It's been a little quiet, honestly, right? It has been a little quiet. In fact, towards the end of this year, the VIX has declined towards historically low readings. Now, obviously, this is not indicative of market performance because the VIX simply measures the amount of out-the-money options that are being bought across the S&P 500 futures, right? But this might give us kind of a knee-jerk reaction in the markets where people start to purchase more VIX, or they start to look at it as more of a star of a return. I don't know about you guys, but I have some UVXY and some VIX as a precaution against my portfolio because the market is at all-time highs or have been at all-time highs for a while, right? Obviously, given the positive outlook for the economy and corporate earnings, the emergence of any pullback will prove temporary and would be buying opportunities in equities, right? We want to follow the trend. We still think that, remember, I'm not saying the market's going to crash. Oh, we're going to go crazy next year. No, that is not what I'm saying. What I'm saying is the trend is still bullish, ride the trend. But these are a few pocket of things that we need to have at the back of our head when we are thinking about these markets, right? The US market especially. The VIX is awfully quiet, right? We haven't seen spikes. Not only that, returns to the S&P 500 have been at double digits for the past 3 years, right? And so all of these things point to just a little bit of precaution, okay? Just a little bit of precaution. Now, the other thing to keep in mind, which is not a problem yet, is margin debt, okay? Margin depth is at an all-time high, and obviously this correlates with market tops. All right, it's not typically a problem. Margin depth is the amount of money that people are using in terms of leverage, right? And what happens is this only becomes a problem when markets top out and rolls over, and people start covering positions and start taking profits, and this causes margin calls for traders in the red, which causes a vicious cycle spiraling downwards, right? And we've seen this happen before in May 2018, right? And now that the market is at all-time high, a margin depth is obviously at all-time high as well, because people borrow more and lever themselves up more when the market is going higher, okay? The other thing is the net free credit, which is the deduction, right, of margin depth from credit. And the margin depth is now double net free credit here, and this is only a problem, right, if it bottoms out and sustains a rising trend, because more leverage will be undertaken without the ability to cover. So what is net credit? That is the amount of money sitting in the accounts as cash, right? It's like, how much money do you have to cover your debt that you're taking on? Well, now the margin depth is double of the net credit. So you see how that might be a problem, right? But remember, this is just things that I'm pointing out that are glaringly obvious, right? But remember, it needs to be sustained for a long time, right? But this could be things that cause markets to rug pull, okay? I'm just pointing it out for you, all right? And then lastly, right before we end this part of the webinar, and I make a huge announcement, so make sure you stick around for the next 10 minutes, is the seasonality, where we are, right? Market has been following general seasonality, and now in November we expect a little bit of a choppiness before the Santa Claus rally in December, right? In fact, the end of November tends to see a rebound, and we'll see maybe the next, next 1 week, see a possible sharp snap back into reality. This week being a very short trading week, traders closed out majority of positions, and we've seen a little pullback in the market, right? A lot of people were thinking that this pullback oh no, we're gonna go down again and Goldilocks moment, right? But no, not really, right? We see this, the sustained trend of the market is still very bullish heading into the end of the year. And in fact, statistically, every year that we've had a 25% rally in the market, the next couple of months have led in a 6% increase on average. So statistically, this market is going to keep going up. All right. Okay. Well, we're going to do a technical analysis update. But now, since the webinar has come to an end, I want to give you guys a quick announcement on something that I want to only announce to you guys who are here for this webinar. All right. For all of you that are here and you are on this webinar, we are announcing a 40% off flash sale for the day trader bundle, and this is only going to be valid for the next 24 hours. All right. Use the code FLASH40. It is case sensitive. Make sure that flash is in all caps if you're going to purchase the bundle, and you will receive 40% off that course, which means you're going to save $344, bringing the course for 2 courses, the beginner and the technical analysis course, at $516. This is the biggest freaking discount I have ever given, and I wanted to do something special for you guys, for the people who attended this webinar. Okay, so FLASH40, if you were thinking of getting the day trader bundle for the upcoming course, remember this is the last live courses that we'll be holding for this year. Okay, wave number 28 and 29. I can't believe we're already at 30 waves this year. It's nuts to me, right? But using the code FLASH40 will give you 40% off on both the trading courses. This is the steepest discount we've ever given. and I hope that you guys enjoy it. All right, this is from me to you as a thank you for attending the webinar, and we will, be doing this only for 24 hours. All right, the code is only valid for 24 hours, and by the way, it's only going to be for the first 50 people who sign up. All right, so I highly recommend, if you haven't taken the mentorship course, you're intending to join us, this is the damn moment. Stop waiting, it ain't getting cheaper. This is the moment. All right, this is the lowest the prices will ever go, because I believe in making trading affordable for everybody. Okay, learning trading affordable for everybody. I already took the beginner's course. Can I use the code just? Unfortunately, it's only going to work for the bundle. It's only going to work for the bundle. If you want to just join the technical analysis course, you can still get the technical analysis course discounted. Today is the last day for purchasing the course at the early bird price. You should go and sign up for it today, because tomorrow it's going to go up to $480 versus the $408 that is at right now. If you haven't purchased the courses, you have to purchase it right now. Now, we will also be holding a Black Friday sale for Discord on this Friday. All right, we will be holding that course on that discount on Friday. So look out for the announcement on Instagram, and you will be able to buy the discount for our EGA Discord. It'll be 15% off all the subscriptions, even yearly. That's going to be also another sale. Okay, so Friday will be the announcement of the Black Friday sale for the Discord. For those of you that have been waiting to join us, you have been following us for a long time. We wanted to put out something to thank you guys, and since it's the year-end Black Friday sales, this is what we want to do for you guys. All right. I took the OG option swing EGA beginners course. Is there anything different? Yes, Cody, it is a little different. We have changed the way things are done dramatically. With the beginners course now, you will be receiving 2 months of Discord access if you take the bundle, and that comes with live trading sessions along with it. In addition to it, the course is now very properly structured with a very revamped curriculum. Okay, 15 for the Discord. That will be on Friday. Okay. All right. So Flash 40 is the code for those of you that have been waiting. Let's get into the technical breakdown of the S&P 500 really quickly. I'm gonna do that, and then we're gonna end this webinar. By the way, guys, this replay is not going to be available right away, okay? So it's going to be exclusively for those who have attended right now. The replay is not going to be available after this is over just yet, okay? So let's look into the technical analysis of the markets. I want to just give you guys a quick little overview. Where we are, where we've come from this year. So looking at forecast for this year, the 61.8 extension here is going to be almost close to $500 on the S&P 500. Okay, more than likely here, if we were to pull back, the pullback ends at 3 to 5%, which would be either here or here. Okay, at this volume shelf, which is at 452. So 461 and 452 remain very, very clear support levels for the S&P 500 right now. This will also coincide with the 200 EMA, and also the 50 EMA will start to flatten out here. Okay. If we can find support here with a strong bounce heading into the end of November, we should see the next wave start and head up into the extensions here. If we start to reject these levels here, then we will start to see further downside extension, and the next pivot point will be the 452 level here, which will be the key level. If we do break below 461-ish, then we will see a downside slide into 452, 453, and 454. So that's what you have to keep a watch on the S&P 500 here. SPY going into the end of the year. All right. Just keep it simple, pivot points. I'm not going into anything else here. Okay. With the QQQ, We have key support levels at 396, which was one of them. We bounced pretty strong. And then the next one is 388. Okay, these will be the two levels. Last line of defense is 382 here. So these are the three levels that you need to watch out for. Support at any one of these levels will send us back up to these extensions up here in 411, 420, and 430 something. This is the 23.6, 38.2, sorry, 38.2, and the 61.8 FIB extensions for this next wave to the upside. All right, very simple. Keep it easy. Don't, take things out of context too much. All right. Looking at IWM, Russell 2000 small caps, right? Nice retracement back into the supply zone, and we'll see if we can get a bounce out here, right? This will be the bounce zone. Support is at the current level, 230 to 231. This is the main level at which we want to see support, okay? Now, bounce up to here, we'll see definitely a nice extension into the next leg. And where may that leg be? If you do not know how to use Fibonacci's, we also teach that in the technical analysis course, just so you guys know. So the extension into the Russell will see us move into the 250s, 252s, and the 257s, perhaps next year, if small caps continue to see growth and they continue to see inflows. Okay. So these are the key levels on all three indices, and we will be watching these closely. All right. The VIX has been pretty flat. I want to say trading up and down. I have some hedges. I will be holding them for the long run, and I have shares of UVXY. The VIX climbing back into the 3, 4. Okay, so there are key levels on the VIX, right? 16 is the nominal, no fear. 18 is some fear. 21 is fear accumulating. Above 23 is fear accumulating at a higher pace, right? So we are starting to see some waves here, but we don't know. I don't know if we will actually break 2150, but if we do and we start trading above 2150 on the VIX, that's when some alarms will start to blare. Okay, that's when we start to see out the money options being bought. And that's all I have as an update for you guys with the US economy. Still bullish, still definitely looking at a good double-digit return, but lower double-digit return next year. Chinese markets to rebound, that's a summary. Inflation to be transitory. These are all of the key points of this webinar, and I truly hope that you enjoyed it. Okay. If you did, let me know in the comments how you felt about this. Do you want me to hold more of these? I'm seriously considering holding one of these maybe every month or every 2 weeks or something like that. How often would you like these? Maybe they will just last for 30-40 minutes and I'll just cover a fraction of what we covered today, right? Pretty in-depth, and we can do this pretty simply. Okay, I'm going to start taking questions now, Q&As. So make sure you guys start posting your questions, and I'm going to start answering them right now. Let me just really quickly have a sip of water, and I'm going to start answering your questions. Nice to see you guys. Nice to see you guys. Okay, remember guys, Flash 40 is the code for signing up for the mentorship course. Okay, on what basis the market is controlled by regulations and CCP is controlling the regulations? We have to study CCP before concluding on Chinese stocks, especially investing in Chinese stocks in US. Of course, definitely. As I mentioned before, there is a huge risk to doing so. What's important is you understand that there's a risk in everything, right? And the correlation between risk and reward is linear, right? The higher the risk, the higher the reward, right? Remember that. So right now, Chinese asset class is extremely risky, and that's something that will give you a proportionate reward in the long run, right? They are saying that small caps will outperform large caps for the next 10 years. Is there any possible truth in that statement? Should we rebalance our 401ks to have more weight towards small caps? Absolutely not. Please do not do that. What are small caps and what are large caps, or what are mega caps? Small caps are companies that are undergoing growth periods. Now, you need to understand that these are typically smaller startups that have just started and are accumulating cash flow. They typically have negative free cash flow, okay? Negative cash flow. And when they have negative cash flow, the market starts to price in growth rates, okay? Now remember that we are in a market cycle where valuations are stretched. They're frothy. We're not in a bubble, but they're frothy, right? We are in a frothy bubble, which means to say we are entering bubble stage. And these valuations are supported by growth rates that are being purported by easy money that has been abundant for a long time. And remember that as the Federal Reserve starts to think about tapering rates next year, that's going to increase the discount rates on these stocks. What does that mean? When we do valuations on stocks, we look at the 10-year bond as a risk-free rate. It's called the risk-free rate. Okay? Risk-free rate. And the risk-free rate determines how much of a discount you're going to put into that stock. On top of that, the beta of the stock and the allocation into shareholder equity and stuff like that, they come together with how much we're going to discount the share value. And when valuations are frothy and the Fed increases interest rates, this will discount that valuation even harder. And when that happens, all of these beta stocks, which are small caps, will have valuations that are crushed. So even though, yes, small caps are going through a breakout, I would allocate a smaller percentage of it into your portfolio and don't concentrate making it or shifting the weights in your 401k. That is your cream of your portfolio, and you need to understand that it is going to be leading the way in terms of your asset returns. So don't shift your portfolio weights, in my opinion. How does the VIX work against leveraging against the market? Okay, the VIX is the fear indicator that is measured by individuals buying out the money options on the SPX futures. Jesus, why does this thing keep? Okay, so when people start buying a lot of out the money calls and puts, right? Out the money calls and puts, that creates uncertainty in the market and it increases volatility. And that increase in volatility is what causes the VIX to spike. So when that volatility increases, the VIX is used as a hedge because things become more uncertain in either direction. Basically, it is a non-directional bet against the market because you don't know which direction it's going to go. It could go up or down very quickly. And when volatility increases, that means that we will see increases and decreases in price action very quickly. Okay? So therefore, when you don't know the direction, you bet on the volatility, and that's an easier way to hedge against your portfolio. I hope that answers your question. Okay. I already took the beginner's course. Can I use? Okay, I answered this question already. I took the OG option swing class. Okay, I answered this question already, Cody. Good work. Thank you. Sick T. Thanks, man. No problem. Absolutely. Weekly, every week again. Would absolutely love these as often as you can. Thanks, T. No problem. I always tune in. Gotcha. Thank you, Ahmad. Appreciate that. Bi-weekly would be good. Let's go. Good job, T. Thank you. Thank you. Every 2 weeks is awesome. Are EV stocks overvalued? Rivian, Lucid, what market forces have made EV stocks to become so bullish lately? This is a great question. Okay, so just like everything in the market, when speculation starts to rise, valuation starts to get stretched, right? One of the most important things is right now there is a big drive for understanding that oil prices are starting to go up. Okay, oil prices are being controlled as a contrary move to last year. So I don't know if you guys remember, but last year we had oil prices that were in the gutter. Okay, and when we had oil prices in the gutter, OPEC Plus, which is the world's controller on oil prices, they actually weren't able to get majority of returns on their investments, right? So when this happened, they were kind of put in a situation where, you know, they couldn't really get much return on their reserves, right? Now that oil prices are starting to rebound and demand is starting to catch back up, we're starting to see that these EV companies are starting to get bought up as a sympathy play on oil prices going up. It's a variety of different things here because the prices of EVs are coming down, the market saturation is getting deeper, and even for those of you who are in Singapore, I don't know if you realize, but there are more Teslas on the road, right? So together with the bullish deliveries of XPEV, NIO, Tesla, these are all things that are driving the EV market into speculation. Does that mean that you should hop on this bandwagon? You should definitely not chase what is going on here, right? Because we want to really see established track record of these businesses, and Tesla is now establishing that track record before you start investing in these businesses. Remember, valuations are done, on a case-by-case basis. So I hope that answers your question. Awesome, thank you, T. No problem, Juliana. Appreciate the detailed webinar. Would love to have a weekly Monday 2-minute analysis of SPY, QQQ, IWN, and VIX. Okay, got it. Man, T, I could learn from you all day. Thank you, man. What's your take on Moderna? Long story cut short, Moderna, I think it went through a period of inflated valuation, once again speculation, and then it deflated, and now market prices are kind of just adjusting back to baseline. That's what I think. With all the fintech like Upstart, Affirm, SoFi, PayPal, Visa, M down significantly, do you see this as an opportunity to catch the falling knife or be patient and wait for renounce? Never catch the falling knife. Always wait for support levels to be established. Wait for the demand to come back, and then honestly, I think that sector is it's a pretty decent sector. Just that you gotta wait for these markets to kind of bounce a little, right? Can you comment on the high yield FI market? Credit spreads are tightening. How do you see post-rate hike affecting high yield? Okay, so this is a interesting one. I think I had a discussion with this about with one of our mods. So credit spreads are an interesting one here. Remember that whenever we talk about bonds, right? We talk about the returns on bonds being eroded more aggressively on the right tail, which is the fat tail. The longer term bonds, right? Your 20, 30 year plus bonds are the ones that are more likely to be affected in terms of price than the shorter term bonds. And when we talk about the spreads, we talk about now the 20-year bonds and the 30-year bonds yields are starting to kind of invert. I've had this question posed to me before, and here's my take on it. I think it boils down to the time horizon of the bond market expectancy. And here I think we are talking about inflation being transitory, and this is something that I think the bond market is starting to price in. That yield is starting to converge, and is starting for the credit spreads tightening are mainly because investors are starting to flock more towards the shorter term bonds than they are on the longer term bonds, right? And when all else fails, people tend to flock to shorter term bonds when the market is uncertain. And that's usually the first warning signs. If you realize last year, pre-COVID crisis, that's exactly what happened, right? But right now, I don't see it as a big problem. I don't really see it as a huge problem. I just think it's just a minor kink in terms of the choice of bonds. That's all. Yeah. What's your take on UPS? I haven't looked at UPS actually. Let's see. Well, certainly looks interesting. Looks like it's basing, but remember you have a supply zone up here. This could be problematic. Watch for the rejection and possible rejection down here. Then you have a demand zone that comes in right here. It's a big drop in between. There's a dual zone in between as well. Lots over here, right? For those of you that are interested in learning charting, remember the TA course is for you, right? Even the beginner course, I kind of go over charting, but the beginner course is more of a comprehensive course. Charting is more done in the TA course, right? But if you want to learn how to, figure out all these things, you absolutely want to take the TA course, right? Looks like a rejection here leads down into the supply zone, into the dual zone here, and then if we continue to get falling, a falling pattern here, then we'll see continued descent here. But so far, in the 4 hour, it looks like a bull flag to me. This looks like a bull flag right now. Breakout on either side will lead to the upside or downside. Play the pivot points, and that's all you got to do here. Keep it simple. Hi, sir. Can you share the view why Lemonade shares keep dropping? Interesting. I have no idea. I don't follow this stock at all. It's one of those types stocks that were hyped up early and traded into a high aggressive valuation, and then now is starting to see a big decrease. I'm guessing it has something to do with earnings. Yep, earnings, and then it gapped down. You have to look at the earnings to see what's going on here. Okay, can you do these weekly? I love this. I'm just tuning in and I love it. Yeah, okay, sure. I could do it weekly. Maybe we'll hold it every Wednesday. Well, okay, hold on. Guys, very quickly, those of you that are here, I need to get a consensus. Is 7:30 PST a good time for all of you? Number one. Number two, what day do you guys prefer if I'm going to do this weekly once a week? Another view on oil commodity spike in price can be a common inflation hedge. That I hate that as a inflation hedge. I still think that inflation hedge, buying SPY puts is a better way. I see 5 Tesla on average every day now in Singapore. Yep, that's exactly right. What are your favorite sectors heading to 2022 given current circumstances? Energy, financials, consumer, discretionary and durables, and technology. Those 4. Thank you for this webinar. Thoughts on FB for a 2-month swing? I'm already in them. I like it. It did break below the trend, but I think it might buy up here. We'll see. I have open position targeting for the 360s. I think that it could push a double, like a bottom here. Okay, so some people direct to Kramer for lessons. I send them to you. With them being in the news for video plans. Yeah, that's absolutely some way that you should not be doing that. Kramer is, yeah, he could be pretty terrible sometimes. Is there a chart or index that allows us to measure how much money in the economy is currently on the sidelines waiting to be invested? We typically look at that as the money force or the flow of money. And I get institutional reports on that. I think there might be, hold on, let's see. I forget what is the exact indicator. I don't think there's an index for it, but I definitely get institutional reports telling me That's one of the things. Like like, you got to pay for that kind of information, right? Some Southeast Asia plays for UT with Grab going to SPAC and the next quarter. SE. I like SE as a Southeast Asian play. It's a great purchase even at these prices here. SE came down really nicely. I think it's a solid spot to buy it. Dual zone right here. Solid little time to pick up shares if you don't have this company after earnings. But of course, remember, don't try to catch this falling knife. Wait for the bounce to happen. Wait for that two-wave confirmation as we talk about on the beginner's course and the technical analysis course. Okay, let's see. Tuesday, 7:30 Wednesday. Time is good. Best are Monday to Wednesday. Earlier is better as an East Coaster. Weekend would be nice so we can prepare for the week, but whatever works. 7:30 on Wednesday is great. Yes, sir. 8:30 p.m. 8:30 PST Wednesday for class. 9:30 East would be good. Can you briefly interpret? No. Okay. Okay, what I'm hearing, majority of you are saying 7:30 p.m. Wednesday. 7:30 p.m. PST, right? Okay, I will look into it and talk to my team, and we will try to come up with a webinar every week for you guys at 7:30 p.m. PST on Wednesdays. I think that seems to be the consensus. Midweek, and that should be helpful. 9:30 Eastern is ideal. So that's isn't that 7:30, close to 7:30? 7:30 p.m. in EST. That's 8:30. Oh, okay. So then you're saying 8:30. Okay, so, well, can we just agree on 7:30 maybe? Or is 8:30 better? 8:30 is okay for me too, honestly. Okay. Let's see. We'll figure it out. No worries. I'll figure out what's the best time. Maybe I'll put up a poll on Instagram too, and we'll go by consensus. Okay, let me answer this last question, and then we're going to end this webinar here for today. Remember, guys, I've told you, this is the last chance for you to get an insane deal on the course. I assure you that this price is never coming back. Never. This is a one-day deal. Okay, it's a flash sale. So 40% off on the day trader bundle, which is both the beginner and the technical analysis course. I have never made this kind of a price available. Oh, wow. Okay, guys, I'm just letting you know that 20 coupons have already been used from what I'm seeing. There are 30 more spots available for that coupon. If you want to still make use of Flash 40, make sure that you go and grab that code right now, because from what I'm seeing is a lot of people are taking advantage of it. Now, whether you want to attend the course live or not, I highly recommend you to take and purchase the course, because you can attend the course offline. It'll be sent to you. The recordings will be sent to you even if you don't, if you don't attend the class live. How do you join? You click on, go to our website, learncompoundgrow.com. Here, let me post the link to how do you sign up. Here you go. Use the code FLASH40. Oops. Why wouldn't it let me? Remember, it's one word and all caps. Here you go. That's where you sign up. I just pinned it so that you guys can have a look at it. Okay, last question was, can you briefly interpret when volume is more than OI for options and OI is more than volume for options? What does it mean for both scenarios? Nice question. That's a good question. Okay, So let's talk about when volume is more than OI. It simply means that there are a lot of people, pretty much are trading that option more aggressively than usual. The open interest represents the amount of open contracts for that specific option on that day. Now, what's important is you look at what the open interest does the next day in order to validate if that volume was implied into the options chain. So, for example, if volume is 9,000, that means 9,000 contracts were traded since the day started, and open interest is 3,000, which means 3,000 people are holding these contracts open. And then the next day, you see open interest is now 5,000 and volume is now down to 4,000. This means less people are trading it today, but more people are holding those contracts tomorrow. And that means that there is more open interest. That means there is more people betting on that strike and expiry. I hope that makes sense. Now, we teach this more in detail during the beginner course. But that's in essence what you need to understand about it. You can't, because open interest can't be tracked live. It's tracked day over day. And you need to pay top dollar for that kind of information. Like I specifically pay a lot of money for tracking open interest. All right. Well, that was a great webinar. I hope you guys had a great time here, guys. Once again, 40% off the day trader bundle. I don't know what to say to you. This price will never come back. I hope that I'll see you guys in class. It looks like we are going to have a pretty full wave here. Quite a few signups already. Thanks for signing up. Those who did, I'll see you in class in December. Those that haven't, I highly recommend you to go take advantage of it. And for everyone else, we'll make more announcements on Instagram. And as I mentioned, remember that on Friday we'll be announcing the Discord sale, which will be the Black Friday sale for Discord. And that will be 15% off on our Discord subscriptions. Sorry for the late question. I'm asking from my GS phone because I'm streaming this on my... Okay. Our courses lifetime access. Yes, they are lifetime access. You will attend all future live trading classes with us. And with the day trader bundle, don't forget that there are added bonuses because you get 2 months access to the Discord. You get 2 months. We throw in 2 months of free access to the Discord. Okay. With the day trader bundle. So basically you're paying $516 for the 2 courses plus 2 months access to Discord. I'll wait for you to show me a better deal elsewhere. I have made it extremely affordable so that people can learn, compound and grow with us, and the tribe is gonna, be able to benefit. Okay, sorry, I think somebody had a question. Luba, I was waiting for your question. If not, I am gonna end this webinar. I'll give him a minute. Thank you, T. No problem, Peter. Okay, I don't see any questions. Luba, if you have a question, reach out to me on IG. I will be more than happy to answer it for you. At Everyday Growth Advisor. Okay. Sorry. TV from my own personal phone. However, I followed you back from when you were in option swing. I was just wondering how you think Tesla will react in the few weeks. Oof, that's a very tough question. I myself would not be able to answer that question. I mean... thanks for following us back from when I was in OS. Tesla does seem to be in a slight corrective phase, but also looks like a kind of a big bull flag to me. As long as it stays between these two, you know, big pivot points. Play it by the pivots here. I really like, you know, as long as you can get above 1128, this would be a key pivot. You know, once again, above 1152, you know, leads to a gap fill up here. And then above 1200 will probably lead to 1242. Play it by the pivot points in Tesla. I can't really tell you exactly where we're going. But that's, you know, mainly what I'm looking at over here in terms of the bigger Fibonacci retracement. We already hit the 50% retracement right here, so that was expected. All right, I hope that was helpful. Guys, have a great rest of your day. I will catch you guys soon. Take care. Once again, make sure you use the code FLASH40, and I will see you guys when I see you guys in class and maybe on the next webinar. So take care, and I will see y'all. Bye, peace, love you all, and see you on the next one.